company's year gross profit margin remain unchanged from year 3. Year 3 and year 4, the gross profit margin doesn't change from these 2 years. Gross profit margin is equal to gross profit divided by sales. This amount is equal to this amount. However, the company's year 4 net profit margin, here is the idea. He was talking about the gross profit margin. He is now talking about the net profit margin. The net profit margin increased from year 3. Net profit margin increased from year 3, which means X amount is greater than Y amount. Net profit margin is equal to net profit divided by sales. Which one of the following could explain the change from year 3 to year 4? Number A, sales decreased at a faster rate than operating expenses. Sales decreased at a faster rate. Sales minus cost of goods sold is equal to gross profit minus operating expenses is equal to net profit before tax minus tax is equal to net profit after tax, or we can call net profit only. Net profit only, it means after tax. If sales decreased at a faster rate than operating expenses, sales decreased at a faster rate than operating expenses, which means, for example, sales decreased by 10% while operating expenses decreased by 9%, it will cause that this amount will be less than Y. X will be less than Y. And you can ignore this answer because sales is given in these both choices. So it will not decrease or decrease, increase or decrease. Solution B, corporate income taxes decreased, which is the answer. If the income tax decreased, it will cause that the net profit will increase. Here you can see that the net profit will increase from year 3 to year 4. X will be greater than Y because the tax rate decreased. Here is the answer. Solution C, preferred dividends increased, which is far away from the proof because dividends is taken from net profit after tax. Dividends is taken from this amount. So we have to reach this amount first to take dividends from it. So C is far away as a solution. D, cost of goods sold decreased relative to sales. Cost of goods sold decreased in comparison with sales. Cost of goods sold decreased. If cost of goods sold decreased in comparison of sales, these 2 years will not be equal concerning gross profit margin, because if cost of goods sold decreased, the gross profit margin in year 4 would be greater than year 3. So the relationship here will not be equal. The answer is B.